Welcome to Investors Insights. Our topic today is when people work, markets work. A lot of great data this morning as we ended January and began February. This has been one of the best Januaries in some time from a market history standpoint. And Bobby, you started us off with talking about rates in terms of bond yield, so talk more about that.
Yeah, we're watching the price action of the 10-year Treasury yield. Last week, you had the biggest drop in over a month. Even after a great jobs report on Friday. So the 10-year currently at 2.7%. So we're having some economic strength that usually drives rates up, but then the Fed holding steady is driving them down.
Yes.
And that can be impactful because business loans and mortgage rates are becoming more affordable with lower rates. So 30-year mortgage rate at the end of last year was 5.1%. Now it's averaging about 4.6
All right,
30-year.
say it a little slower here. Okay, mortgage rates.
Mortgage rates.
Somebody's shopping for that new house or to move now. Mortgage rates were?
5.1% on a 30-year mortgage.
And today?
Around 4.6. So much more affordable. So we're looking to see the housing market re-strengthen, especially going into the hot season.
Right, and if you watch our previous vlogs, we had conversations about that as the Fed talked about raising interest rates or did, and we're seeing those dynamics change as we talked about in previous vlogs. And actually tied to that, so when somebody's buying a house, they should have a job.
That's right.
So you brought up about jobs. Talk about that.
Well, the amazing thing is, we were talking about it this morning, the job growth is accelerating, and it's accelerating late in the cycle. So if you look at it in 2017, it was 179,000 jobs per month created. Mm-hmm. Then you dial that up to 2018, 223,000. But the interesting thing is, the last 4 months of 2018, we saw that market choppiness.
Right.
It created 250,000. So when you look at 2018, 1.3 million jobs above where economists forecast it would be, were created in 2018. But this growth is occurring faster and faster later in an economic cycle. That almost never happens.
Right, but on our vlogs, we've had discussions about, that this may be late in the cycle, or it may be the beginning of a new cycle.
That's right.
And if you go back and check us on that as well,
yes,
that would be good. And Adam, you brought up, though, with people, jobs in terms of where they are in this country in terms of paycheck to paycheck.
Yeah, absolutely. To your point, Ashley, the jobs number was incredible for January, 304,000 against the estimated 165,000. That's a big gap. So we're starting to see that jobs growth continue through the end of 2018 on to 2019. That was despite the government shutdown. We also learned a fact that 40% of American households are one missed paycheck away from poverty. Now that's kind of scary for some individuals. That might encourage people to stay in the jobs field. Look for new jobs, keep their job, keep that paycheck coming.
Yeah, I think last week Ashley had a good stat that we're finally seeing that underemployed group of people, underemployed come down.
Yes.
That's been 20 years since we've seen that. So that's that one paycheck away from poverty group is getting those jobs and keeping them. So,
Yeah, and that can dig right down to consumer confidence, and that leads to earnings. So it's going to be really important over the next few months to watch these companies' earnings, see if these paychecks, kind of deviates off that plan.
Yeah, I think we're kind of in a really Goldilocks situation of not too hot, not too cold, and that we got a perfect storm of great economics data, but it's not so good that it's bad and that it causes the Fed to raise rates or higher inflation. We're seeing economics growth, jobs growth. Consumer confidence took a dip at the end of the year. I find it hard to see that consumer confidence won't go up now that we had 200,000 new jobs created. So we're seeing economic growth, but also interest rates are coming down. So the opposite. So good news is good news right now, so we're kind of in a really good, unique, sweet spot.
So corporate earnings are doing well. Yep. People can borrow money, buy a house, jobs can expand, products are being purchased, consumers have money in their pocket.
And all this is in the U.S.
Yeah, absolutely. So, and then let's talk about from an international standpoint, because we fought through last year with all the negative news. Yes. Talk just a little bit, Ashley, about the China situation, because everybody heard China tariffs. Right. What's the reality happening here?
Well, we've said this many times on the vlog. The Chinese just can't hang with us head to head for too long. It's the structure of the economy, it's the size. Yet one more indication of that is the Shanghai and Shenzhen indexes. 395 companies on that index for 2018 showed a loss. You can't sustain that. It's revenue dropping, it's writing inventory down. I mean, if our own index has had that many losses, we'd be calling out the National Guard or something. I mean, basically, and that's how bad it is over there. They can't hang. They just can't.
Right. So on that note, we've got a lot of positive things going on in this country. We're excited about the economic data and what we're hearing in research, as well as through our clients on their personal careers or the companies that they work for, or the companies that they own. So we're going to keep you updated as we go into February. We think we've got momentum here. We appreciate you taking time to share this, to listen to us, and hopefully hear news coming to you, information that you're not hearing from anywhere else. Please take it and know we're using it in relation to your portfolio and your financial blueprint. And we thank you and honored to be working with you. And for those of you that aren't clients, give us a call, send us an email. We'd love to have the opportunity to talk with you. Thanks again. Have a great week.